Good morning and welcome to this Tuesday, July 18th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so as we prepare for the trading day ahead. Currently, we got futures down a little bit, not really a lot. We got Dow futures down 28, S&P 500 futures down about 6. NASDAQ futures down 32. Crude oil prices just up slightly, a little above $74 a barrel, and the U.S. 10-year Treasury yield down another 4 basis points. We're back to 3.76%. Wasn't that long ago we were up threatening that overhead resistance around 4.10, but we have pulled back considerably from that. We've got a Fed meeting coming up next week. It's going to be an interesting time for the market. I think honestly, I think the way the market's trading, we're looking past the Fed. The Fed's talking tough still, but I believe the market is focused on the fact that inflation is rolling over, that the Fed is not going to be a problem going, past the next month or two, and that's what the stock market does. It looks forward. So I suspect that we're going to continue over the balance of the year to continue to see prices move higher, but the here and now, if you're a trader, there are some warning signs. We've been talking about them. We'll be talking about them a little bit more this morning. Let's go ahead and jump in here. I'll go through and give you a recap first of what happened yesterday. So we started off the week not really too bad, considering that we're approaching the worst week of the year, or second worst week of the year, excuse me, historically. The July 17th close, which was yesterday, through the July 24th close, trails only the latter part of October in terms of historical performance if we date back all the way to 1950. So today it actually begins. Yesterday, though, we were getting close. It was Monday. We were into option expiration week. We got negative divergences. We've got extreme bullishness in the short term in terms of the equity only put call ratio. All of those things can be warning signs. They're not guarantees, but when we start getting a number of them, they start building. They do, in my opinion, at least present something to consider when you are, just trotting out your short-term trading strategy. Dow Jones Industrial Average did finish up yesterday, 76 points. S&P 500 was up 17, NASDAQ up 148, mid caps up 17, small caps up 9.5. Transports, though, down 2. We've been seeing this profit taking and some rotation out of transports. And even though it felt like a pretty good day yesterday, that rotation continued out of the transports yesterday. But, when I look across the major indices, especially that NASDAQ, we're not too far from an all-time high. The QQQ, right around that 400 level, we haven't seen. I don't remember if we closed above the 400 level or not. I'd have to take a look at it, but we finished at like 382 and change. So we're talking about another 5% or so to the upside, and we're there. A lot of folks, poo-pooed the idea that we were going to go back to all-time highs. Most of what I look at tells me or told me once we got through that cyclical bear market, we were back off to the upside again, and we've continued on this path. We do, as I mentioned earlier, we do have short-term issues that we have to at least be concerned about. Could we go higher? Sure. I've seen bull markets go up through just about all kinds of adversity, all kinds of warning signs. So I never rule out a bull market. But there are signs certainly that point to the possibility that we'll see a little bit of weakness in the near term. And what we might go up for 3 days and then go down for 3 or 4 days and really still not be much lower than we are today. It's really hard to say when this potential selling will kick in, if it kicks in. But I'd say the odds are probably better than 50-50 that we'll probably see some selling. I'm looking at the earnings, Tesla and Netflix come out. I really expect a big report out of Netflix, out of Tesla. I expect a pretty good one out of Netflix as well. But Tesla, I think, is going to blow out their numbers. And if they do, we could see a gap up, and maybe it's a sell-off on that news. I don't know. I'm just speculating, like, possibly anybody else. But watch for it. If you want to stick with this market on the long side, I think that's fine. But just be, just kind of tread water and just be ready for perhaps something that triggers a little bit more of a sell-off, maybe a bearish engulfing candle, something along those lines, or maybe just, a shooting star, gap up a little bit. Maybe it's with those Tesla earnings. You take a little gap up in the morning and you take off, and it looks like the market will never stop. And then you leave that long tail to the top and you come back down, finish close to the open, maybe with that kind of like an inverted hammer, shooting star, if you're a candlestick fan. That type of candle, maybe that is what we need. I don't know. I'm watching it day to day to try to see if there's a particular sign from a technical perspective that kind of corroborates all this other stuff we're talking about. Sectors: technology up 1.28% yesterday. Financials up almost 1%. Utilities, though, on the other end of the spectrum. Remember, utilities were the leader on last Friday, but Monday, not so much, down 1.15%. Looking across some key industry groups that performed well, renewable energy. We've been waiting and waiting, talking about how July is a good month for renewable energy. Well, renewable energy surged yesterday. Top two stocks in the S&P 500, First Solar and Enphase Energy. Those two stocks, especially First Solar, lit a fire under the renewable energy index, and you can see up 8.27%. Semiconductors, despite a negative divergence, continued their tear to the upside, up another 2.35%. And then financials, we haven't heard much from financials lately, but they were a strong group yesterday. The full line insurance industry group, you can see up 2.45%. So those were three of the groups that really performed well on Monday. We'll see if that continues into Tuesday, but especially that renewable energy group. When they move, they can move extremely fast, maybe even faster than the semiconductors. So that's a group, when it starts to, make a move, and it looks like this downtrend's been broken. It's now trending above its 20-day moving average. I wouldn't be surprised to see a continuing push to the upside in renewable energy. All right, moving on, 10-year Treasury yield. First, we do have some economic reports coming out today. June retail sales already out this morning. Last month, June retail sales jumped 0.3%. This month, it was 0.2%, which came in below the expectation of 0.5%. I think we're almost in this mindset again now where it doesn't seem to matter if we have good news. It's, if we have better than expected news on economic reports, it's good because it means the economy is strong and we're not going to have this hard landing that a lot of folks are talking about. And then if we come up short of expectations, like we did this morning on retail sales, it's almost like, well, now, the Fed is probably going to be done, or this is just another point, another consideration that the Fed has to, take into account in terms of whether or not they raise. And by all accounts, seems like they're going to raise next week by 1/4 point. They're talking about raising again another 1/4 point next month. We'll see. But I think it's this mentality that we're in right now. The market just doesn't seem to care. And that's what happens when you get a volatility index that drops back down into the 13s or 14s. Now, we do have another potential issue with volatility, and I'll talk about that in just a minute. But first, June retail sales came in a little bit lower than expected. If we strip out the autos, June retail sales came in rising 0.2%. The expectation was 0.3%. Other economic reports out today: June industrial production, May was down 0.2%. June's expected to be flat. So not exactly, blowing the roof off on the industrial production front. June capacity utilization expected to drop just slightly. May was 79.6%. June expected to drop to 79.5%. May business inventories, this is kind of a report we look in the rearview mirror quite a bit. I mean, here we are second half of July, and we're looking back at May business inventories. But anyhow, they were unchanged from April, up 0.2%. And then finally, the July housing market index will be out this morning. June was 55. July is expected to go to 56. I don't know. Housing market has just continued to be on fire. Maybe a lower than expected number there might trigger some selling. I don't know. I'm just kind of following the numbers. I follow my signals, which long-term remain extremely bullish, short-term remain a little bit dicey, and then we go from there. 10-year Treasury yield. Let's get that update right now. 377. So we're down about 2 basis points from 380 yesterday. So, continuing this short-term downtrend. Again, 370, probably an area of support that I would watch on this yield. You got the 50-day at 373. We went right down there, almost tested that earlier this morning. We'll see. But I really want to show you this VIX chart, because this is another one of these short-term signals that I think we really need to pay attention to. So what I want on here, let me set this chart up for you. We don't need the PPO. We don't need volume. Really don't need moving averages on the VIX. Don't need the AD line, but what we do need, we want to see the S&P 500 price action. And then I want to show you correlation between the VIX and the S&P 500. And before I pull this up, you should know that there's always, or generally, an inverse correlation. Volatility measures essentially fear. More specifically, volatility index is a measurement of, it looks ahead to the next month's S&P options, and it's really looking at the premium on those options. And when the premium is priced high, if you're an options trader, you know what I'm talking about. I mean, if you're going in to buy an option and there's a big spread and you have to pay a lot extra over and above, if you're in the money, $2 on a stock and you've got to pay $8 and the thing expires in another 2 weeks, that's telling you there's a lot of volatility. You're paying an extra $6 above the in the money premium in order to get that option, in order to purchase that option. Well, the S&P 500 options are priced similarly by market makers. And when they're priced, when there's more premium, when there is a bigger spread, more premium involved in getting into those options, that's telling you that that market makers are seeing an increase in fear or an increase in expected volatility. That's really what volatility measures. It's the VIX that measures expected volatility. And so, well, the significance of the VIX going up is that it tells us that the likelihood of more volatility is out there. It's telling us that fear is building. Well, when the S&P 500 goes up, you'll almost always see the VIX go down, because as prices go up, we get less fearful. We get more complacent. Bull markets are known for a VIX down around 9 or 10, because there is no fear in the market and it's very boring. Usually, we're up 15 points on the Dow one day and then we're down 10. Then we go up 60 and then we maybe come down 15. We just steadily go up, but not a whole lot of, price movement. Well, every once in a while, we'll get these signals where the S&P 500 will go up and the VIX climbs up with it for a period of time, which is weird because it tells us that market makers are starting to price in a little bit more fear, even though prices are going up. And that can trigger a reversal in the market. Same goes if the market's coming down and the VIX is coming down. I wrote an article, you can go back and look, beginning of January, when that was happening, when the S&P 500 was going down, the VIX was going down, the correlation went positive. And when that happens, it increases, in my opinion, the likelihood of a reversal. And you remember in January, the market took off. Well, we're getting the opposite now. So I want to show you the chart. So here's the VIX, and the VIX has been going down. You can kind of see the S&Ps going up. But just recently, we had the VIX starting to turn back to the upside while the S&P was going up. Just here over these last couple of days, and you can see, and even prior to that, there was a little bit of correlation. When the VIX was going up, the S&P was trying to turn up, or it wasn't turning down much. And then we kept going up here for a couple of days as we started this rally. Anyway, what's happened is that when you look at the correlation between the VIX and the S&P 500, we actually briefly went positive. And I'm going to show you that this doesn't happen very often. So we'll just go back the last 5 years. And you can see we stay down near that -1 level. And when we have these short-term spikes, if you go back and you look, right here, we got close to positive, and it was right around near a market top, very close. Here, we turned positive right at a market top, reversal. Here, this one, we were still, looks like we still went up for a little ways, and then we had a slight pullback. This one, look at this. I mean, this was the most positive correlation that we have seen in 5 years. And it came right at the top. And if you go back and you look at my Trading Places blog, go back into the archives. And I'll tell you what, after we do this, I'll show you. Remember, beginning of September 2020. Here we had one on the move down. We reversed back up. Here, not so much on this one. Here, we got up right here to the top. Here's the short-term reversal. Here, we got to a top, short-term reversal. Here, we get to a bottom. That was where I was talking about at the beginning of January. This is where the S&P is going down, and we get this signal, and it reverses back up. So now what we've got is we're going up, and maybe the timing's not going to be perfect, but this is yet another short-term signal that tells us we need to be careful. So the market may keep going up, but it still, I think, pays us to recognize these short-term signals. Now, let me go and show you this article from back in September 2020, right here. S&P was going straight up, and we got this signal right here. And let me show you the article. So if you go in, you can get my blog. And then right here, you can click on blog archives, September 2020. And it was right at the beginning of the month. Right here, September 3rd, 2 sentiment indicators suggesting extreme caution. Beware. Again, that was right in the middle of the chart when the S&P 500 was going straight up. I mean, warning signs, I feel like most folks warn you after everything bad's happened. These signals are golden because they tend to give us signals before it happens. So in that article, that's where I talked about that positive correlation. And so the VIX was going down, but it was starting to turn up. The 5-day moving average of the VIX had started to turn up with the market going up. Here, you can see we started to turn up, but that's because we had a sell-off. That's normal. This one is not normal. And so you can see, and I even went back some of the earlier years and showed, this doesn't happen very often. So when it does happen, you need to at least be aware of it. This is a chart you should absolutely have in your arsenal. It's a short-term indicator. It's not long-term. Notice, in September, when we pulled back, we ended up having a huge run-up after that. That wasn't a bear market signal. It was just a be careful signal. And those are just as important in my mind. All right, moving on, S&P 500. So here's your breakout again yesterday to a new high. I thought maybe we were reversing based on Friday's candle. Just wasn't meant to be. Market, I said, if we go back up and we print new intraday highs, that negates any kind of bearishness from Friday. And that's what we did on the S&P, went back up and set a new high. The NASDAQ, same thing, went up, set a new high. Now on this high, you can see the PPO is we still got a lower PPO, so the negative divergence is still out there. But we don't know how high this is going to go. I really want to see a lower low at this point, because now we've been in this uptrend off of the 20-day test. 1, 2, 3, 4, 5 days in a row now. Higher highs, higher lows. You can't go lower until we get a reversal. So that would be one thing to watch if you are long and you're like, really, I'm hesitating to get out of this thing because it's running to the upside. Hey, I hear you. I get it. I understand. But if it does show signs, if you're looking for something maybe to trigger, some of these other short-term signals that we're thinking about or that we're considering, maybe it's a lower low so that we at least start to show the signs of rolling over. But not there yet. Market just keeps going. IWM, another big day. I thought this one in particular really looked like maybe we were weak, and perhaps we're just continuing in this island cluster, off of an uptrend. We're just kind of sitting here going sideways right now. Maybe that continues and we get a gap down at some point. I don't know. Or maybe we just continue and we go up to this 198, 199 area of resistance. But I do think the character has changed on this chart. I think we have an uptrending IWM. And if it did pull back and gets back down to that 20-day moving average, I'd be a buyer. I think we're going to continue to trend higher on the small caps. So 20-day moving average would be a great entry in my opinion. Transports, and there we are moving down again. Not a lot of selling, but we have moved down, at least taking a break. And that's what's helping power some of these other areas to the upside, because transports were leading. And now we're seeing a little bit of profit taking there. And that money is rotating and moving into some other areas. What I expect is that we're going to see this possibly a 20-day test. But even if we don't, we go back up. Watch this PPO because it's starting to roll over. The next move up on transports, maybe we get a negative divergence. That's something to at least keep in mind. All right, chart of the day I wanted to talk about. So let's first go over to earnings beats. Earningsbeats.com. If you scroll down, if you like these charts of the day 3 times a week, we'll send them to you. We'll send them directly to your email. And all it takes is your name, email address. Hit that subscribe button. No credit card required. You can unsubscribe at any time. I don't know what else we can do for you, to try and help. But please beware, especially if you're, if you've been, just more recently following us on YouTube. Make sure you hit the like button down below and also subscribe to our channel. We're going to be doing a lot more stuff on YouTube. So you definitely want to be aware. But as far as this newsletter goes, it's a very quick read, usually 2 paragraphs in a chart. And again, sent to you directly, usually before the market opens. We try to get it out around 8:30 in the morning, Monday, Wednesday, and Friday. Usually if it's after that, you can thank me. It's usually my fault for just getting it done later. But Monday, Wednesday, Friday, 8:30 in the morning is when it normally comes out. Just sign up. No credit card required. And also when we have free events, we had a free event last night, sneak preview of Q2 earnings. We reach out to our EB Digest community. So make sure you are registered there and you're receiving our EB Digest so that you can in turn be invited to our events when we have them, our free events. All right, so what do we have for you today? Well, yesterday, there's a lot of bullishness going on, but unfortunately, none of it is hitting Disney. Disney has just been awful. I don't know what else to say. You can see the top was all the way back in August, and when the market was moving, Disney, look at Disney, that was a big move up. Then the market came down for the next 2 months. Disney came down, no big deal. Market made a big run in January into early February, and we saw Disney make a move to the upside. But it all started right here with this move down, the gap up, and then the sell-off here with earnings. And that would have been Q4 earnings that came out in February. We started selling. Notice the next earnings report came out in May. What happens? Disney, another big drop, and we just keep moving lower. Now, one thing I will point out is that we are at a really key, or we're approaching a very key support area. That low in December needs to hold. That's down around $84, and we are now down at $85.56. If you're somebody that likes to build positions in good, solid, long-term companies with these big brand names, then Disney is probably a stock you should be looking at. If you're looking at momentum and you're a momentum trader and you're on the long side and you're trying to find stocks that'll make you some money on the long side, unless we get maybe a reversal at that 84 level, maybe a hammer prints or something, this is not the kind of stock that I follow. It's just, I need to see it start showing not only absolute strength, but it needs to show some relative strength. And we're just not seeing that right now. So let's go back. I'm going to stretch this out. Let's look at a weekly chart going back 5 years on Disney. I mean, we topped in March of 2021, and this has been a steady, you can see, yeah, we made a nice move in July and August last year, but it was still within the confines of a long-term downtrend. Same with January. Nothing here has changed. But if you notice that $84 low that we saw in December also kind of lines up with the low from the pandemic. So this is a very significant support level on Disney. I can't, tell anyone to go out and buy. I don't own it. But if you're somebody who does like to accumulate these stocks at key support, major support, I don't know. Disney looks like a pretty good one. From current price down to about $80. You could just have your buy, set up out there. And if this holds, I mean, if it doesn't hold and we go down, we have a weekly close or even a daily close below 80, maybe you want to get out. I'm going to pull up the daily chart again because I do want to go back and just see where that candle was back then. Yeah, it looks like right around the mid 80s was the low close or candle body. March 23rd, that was when we bottomed on the pandemic. The low was 81.09 that day, which was not quite as low as the previous low, but the open was 84.49. The close was 85.76. So at 85.56, we are right now at that pandemic low and just slightly above the low we saw in December. So just wanted to point all that out. I mean, we could take a look at Disney on a relative basis. You can see the AD line, not exactly great. Relative strength, I mean, relative to its broadcasting and entertainment peers, horrible. Absolutely horrible. I mean, I don't like jumping into a stock when it's doing this, but maybe you want to anticipate some relative strength by getting in near support. Really just depends on your style. Anyhow, I thought Disney was an interesting looking chart, so I wanted to point that out as your chart of the day for today. And again, go to Earnings Beats and sign up for the EB Digest if you haven't already, so that you can be emailed 3 times a week, our chart of the day. All right, I want to talk a little bit about our model ETF portfolio. First of all, we are going to delay the draft for this quarter. If you're not familiar with what I'm talking about and what we do with the draft, let me just tell you that we quarterly select a number of ETFs, and you can see these are the ones we currently hold. And we do so in an attempt to outperform the S&P 500. That's the goal. We want to outperform. We use technical analysis. We also will look at sentiment. We'll look at our big picture indicators and kind of get a feel for what kind of upcoming quarter we think it's going to be. We take a look at historical indicators like, seasonality. We know that September is going to be in this next quarter. That's the worst month of the year historically. August isn't a great month. But October tends to be a pretty good start as you go into earnings season. So got a lot to consider, and we're going to do the draft. Normally, we do it on the 19th of January, April, July, and October. But we also know that the 19th to the 25th of the calendar month, historically, every calendar month, that tends to be the weakest time of the month. And I continue to notice there's been a consistency of our portfolios, both ETF and stock portfolios, not performing great after the 19th in that first week. And so why rush it? So what we're going to do is we're going to close out this portfolio like we always have tomorrow on the 19th of July, but we're not going to do our draft until the following week. So it'll be the 25th of July. So it'll be next Tuesday. So no draft. We have that on our schedule right now. I think that, we'll try to get that updated if we haven't already, but there will not be a draft tomorrow night. I just want to make sure everyone is aware of that. All right. Let's see what else to go over. Well, I mean, you can see on the portfolio why we're beating this quarter. The S&P 500 right here, went up 8.95% over the last 3 months. We have 9 ETFs, and 7 of them outperformed the S&P 500. This one, JQUA, which is 15% of our portfolio, was right there with it. I mean, basically, essentially matched the S&P, just slightly below. The only ETF that we had that did not perform well in this last quarter was the XLV healthcare. So that lagged pretty badly. But look at all these other areas. You know, the bullishness that I had going into the start of this last quarter was the reason why we had a big position in the QQQ. I felt like the QQQ was going to outperform the S&P 500. So we put 20%. It was it was that, along with MOAT was our 2 largest holdings in here. The QQQ, though, just looked like, because it has a lot of those aggressive growth stocks, and because I was so bullish, this was a stock, this was an ETF that I thought, really needed to be considered in this portfolio. Sorry. IGV, that's software, great quarter. Technology ETF, XLK, the consumer discretionary group had a really good quarter. Anyway, we wanted to overload those areas because we did feel like those were areas that were going to perform well. They did. And as a result, we beat the S&P 500, or we're beating the S&P 500 somewhere 3.5 percentage points in the current quarter, which isn't easy to do, by the way. Anyhow, again, no draft on Wednesday, but we will be doing it next Tuesday after the close. But so for a period from tomorrow's close through next Tuesday's close, our model ETF portfolio will just simply sit in cash. So if the market goes up, we'll be underperforming. If the market comes back down, we'll start off the quarter outperforming because we're sitting in cash. So I wanted to make sure everybody's aware of that. All right, that's for the most part what I had for today. So I think what we'll do is maybe just take a look at what's going on right now. We got the Dow down 5, NASDAQ down 5, NASDAQ down 39, a little bit more. Small caps and mid caps, though, continue to move up fractionally, slightly, but they are up today. The VIX up more than 1%. And so we see the S&P go up later, and that VIX remains up. That could just add to that positive correlation that I was showing you earlier. As far as the S&P movers to start, you can see Align Technology is the biggest drop in the S&P 500. Winners, Schwab up 9%, almost 10% this morning. Maybe we're going to start seeing many of these financials. We saw financials do well yesterday. By the way, the banks have been performing extremely well. Let me just show you that chart. We'll come back to this in 1 second. But it is broken out above this double top, and it's now got the 20-day above the 50-day. This group is trending higher. You can say a lot of bad stuff about banks, and I have, and I still talk about the inverted yield curve, which is generally not good for banks, but they're going up in spite of it. Maybe the market's looking ahead at something we're not seeing. So banks, keep them on your radar. As long as they trade above the 20-day, this is a group you want to certainly monitor and keep on your watch list. But Schwab having a really good day today, up almost 11%. So nice move there to start the day. Anyway, that's it for me. I'll be back later I'll be back later today for a Max Payne webinar. That is a member-only event. If you want to participate in that, which is going to be an unbelievable sight on its own, because we've had so much move to the upside, a lot of in-the-money call premium. If you want to come in, listen, find out a little bit more about that over at Earnings Beats. If you go to our homepage right there, start your no-cost trial, 30 days for free. Give us a shot. We got a lot of stuff coming up. This would be a great time to try out your membership. And also, we have a webinar special that, because we have so many webinars this week, we have a webinar special. If you go in, if you like our service, you try it out, it's a great time to join, because you'll get 13 months of membership for the price of 12 plus your 30-day trial. So really, it's 14 months for the price of 12. Anyway, that's it. Have a great day, everybody. Happy trading.